Hello, guys. What is happening? And welcome to today's live stream. My gosh, we've had some incredible moves in the bond market today. It's been a incredibly interesting day in financial markets for sure. We're also going to go through a story from a subscriber. And if you have a story or anything interesting that you want to be featured, then just email me, marketmaniacanada@gmail.com. Your identity will always be protected, and I'm never going to give away any of that. So that is all good. You're safe with me. And the other thing I want to say real quick is I was on the Canadian Real Estate Show podcast, and I've left a link below. Check that out on YouTube or Spotify. It was an interesting discussion that we had there. Definitely worth taking a look. So, we're going to go through what's going on in the bond market, the oil market, everything that's going on right now. There is a lot. Before we do that, I just want to go through this quick real estate article, which came up because it's interesting. We were talking about New Zealand last week, and New Zealand is like the banks are begging them not to put in these stricter regulations on lending. And it's funny because Canada is contemplating similar regulations on lending, which would have a dramatic effect. So, will they do it? Will they don't? Who knows? We aren't. I'm not going to be the judge on that, but it's just interesting that they're talking about it. And anyway, we'll go through it, see what you think about it. So let's share my screen here. So Canadian real estate has a new risk factor catching the attention of regulators. CLPs, combined mortgage HELOC loan plans. It's funny how they make these financial products like what they call them is just ridiculous. But anyway, better known as readvanceable mortgages are fueling higher home prices. That was the take from OSFI, which is it says right there, the country's bank regulator. CLPs are rarely mentioned by regulators, but they've come up in several speeches since last year. As interest rates rise, CLPs can provide an elevated risk for lenders and borrowers. The industry is now discussing if further regulations are needed, with consultation potentially beginning this year. So that's interesting, isn't it? Because what's happening in New Zealand right now, and you figure they're like 6-8 months down the road, and they're discussing implementing this right now, which is similar. They're not exactly the same. Um, but it's similar things, lending rules changing, and it's very interesting that they're now contemplating the same thing. It's like who's looking at who. So it's very interesting. Combined mortgage HELOC loan plans, CLPs. Readvanceable mortgages are mortgages combined with a home equity line of credit. Just credit and credit, basically. You pay your mortgage as usual, just like any other fixed rate mortgage. Lenders often only require the interest paid on the HELOC portion, though. The big selling point here is that every mortgage payment increases your available HELOC credit after paying. A portion of the funds are available to be borrowed soon after. That sounds like leverage to me because it's allowing you to borrow. And the thing is, leverage is great when things are going fantastic. Leverage is just great. But when things are going bad, it is so bad. Like misunderstanding leverage is something that happens all the time. There are financial products all over the place, even the derivatives that I trade every single day for different indexes. Those derivatives are highly leveraged, and I could easily, if I had, like, let's say a 50,000 pound account, I could go and leverage like $10 million worth, which is just insane. And there are brokers that even offer like 2,000 to 1 leverage. on derivatives. And we've discussed before, the derivatives market is bigger than everything. And that's because of the leverage in it. Hey, Trent, how's it going? All right, let's go back. So the big selling point here is that every mortgage pay, yeah, so we've done that. Debt products aren't good or bad, but the circumstances in which they use are important. Yep, that's true. One positive is borrowers can tap equity very quickly. This can minimize the burden of negative economic shock, which is good if you can tap home equity at any bank machine. You might not need to set aside so much cash for an emergency. That's great with inflation this high. Readvanceable mortgages are also a key part of the Smith maneuver, a popular financial planning strategy. It involves using the product to convert mortgage interest into a deduction. Rich people have been using it since before I was born, and they'll probably be using it long after. The problem with debt products is leverage works both ways. Whilst home prices were rising, it was easy for some owners to spend $80,000 a month in equity. Spending unrealized profits can be not so fun if they disappear due to falling prices. And that's the funny thing, guys, because if you have negative economic shock, like you have a recession and high unemployment and everything like that, if people are tapping into their equity, that's going to be a recipe for disaster, especially when real estate prices are in the likelihood going to be going down in that scenario, unless they invent some other financial product in order to increase lending. Canadian real estate's fast growth has lenders looking carefully at risk. For example, the chief risk officer at BMO told the bank's shareholders that recent gains may exaggerate value. The collateral value of the home might not be reliable, worth as much as people think it is right now. Consequently, they've had to up manual verification to determine if borrowers will pay, even if prices will fall. So that's interesting, isn't it? That they're saying it might exaggerate value. And they're literally doing this on the back of everything that's happened. Like it's pretty much said and done. And now they're talking about how can we clean up this mess that has already been created. I mean, it's just these regulators are always just 10 steps behind what is really going on. And, they've popped bubbles before in the past. They could do it again. I don't honestly think that we're going to need any regulator to do it. It'll pop on its own. But yeah, it's just it's insane, and it's I need your opinion. Have a huge variable mortgage, $150,000 HELOC, and 1,200 a month vehicle payments. Am I going to be okay? Well, it depends on your situation, what your income is, and everything like that. But yeah, it's just it's funny, isn't it? What else we got here? These exaggerated values can mean a readvanceable mortgage has less than expected equity. If the home values fall below a key threshold, the borrower might need to find some money very quickly. That's a very key point that I want to point out. You definitely need to remember that they might have to find it quickly, which they generally dislike. Yeah, the lenders don't care. I don't know why they put that in there. They really don't care. As long as they're lending, they're happy. That's how they make all their money. These big banks in Canada is lending out. So they really want to lend to anybody and everybody with a pulse. Um, Remember, OFSI's job is to protect the bank's financial system, not you directly. Well, they've been doing a absolutely terrible job of that so far. But would it surprise you if they came in and started regulating stuff and then getting it even worse? And then it says OFSI has flat out mentioned this next one, which is CLPs might be hiding distress. One of the benefits above is being able to tap their home equity if they're unable to pay their bills. Tapping this facility for payments on a second home or to sustain life can artificially inflate values. Yeah, that's very true, especially with the house hoarding that's going on right now. Non-traditional housing-backed lending products such as combined mortgage HELOC loan plans, which can have readvanceable structures embedded within them, may be simultaneously fueling and helping Canadians afford rising home valuations, explained OFSI Superintendent Peter Routledge back in November. If not used prudently, these products can both increase borrower vulnerability and prices. It might be Canada's very own subprime type of mortgage innovation that could go very wrong. That would only happen if regulators ignore the risk, though, which they very much are. That is hilarious that they put that they're not ignoring the risk. It's already happened. The bubble has already been blown to the extreme now, and now they're coming in there. Like, I mean, just ridiculous. These people have got hollow heads, I'm telling you. It's always the same, guys. Always the same. These central planners, central bankers, regulators are always 10 steps behind what's actually going on, and they are absolutely useless when it comes down to the wire. OFSI is monitoring but may further regulate CLP leverage. OFSI has a tendency to go from monitoring to prudential regulation within a few months. The superintendent explained in January, we will ensure that lenders offer combined mortgage HELOC loan products, CLPs, risk weight that exposure to reflect tail risk for a loan that dynamically readvances credit to mortgage of up to 80% of their home's current value. Good Lord. Oh, thanks so much for the super chat. That means a lot. Thank you so much. That's great. Um, thank you. Super underrated channel. Hit the like button. Yeah, you hear him, guys. Hit the like button because sends the notification out to YouTube that we're live. A tail risk is one with catastrophic impact that is unlikely to happen but can occur in rare circumstance. Yeah, things like global war, an inflation shock, or Toronto condo prices dropping 1%. You know, a little bit of sarcasm there. I like it. Things people will never think will happen in their lifetime. Yeah. OFSI slipped regulations into the last guideline B20 update, better known as the stress test. A CLP can technically have a combined loan to value of 80%, meaning borrowers can have 20% equity in their home. The guideline now advises lenders to maintain an authorized LTV of 65% or less for the combined sum of the mortgage and HELOC debt. Now that's really interesting. So they're advising this. Is it going to actually affect things? I mean, I don't really think so because it's just advice at this point. But I mean, if they have to pull back, people are going to suddenly have to find cash if people are over leveraged. And this is one of the things about being over leveraged. You take a big risk. Like there is substantial risk there. So the next guideline B20 is likely to be an open industry consultation on CLPs. Federal employees familiar with the issue have said preliminary discussions have already begun, though with the number of times the OSFI regulator has suddenly mentioned them, it wasn't hard to see. Okay, interesting. So that one is an interesting one, isn't it? Because basically, I mean, I find that really, really interesting, guys, because essentially, if they did that, that would have a substantial effect because that is literally pulling back people's leverage. So thank you so much, Calsum, for the super chat. Fantastic. So let's carry on with this show. All right. Oh man, you know what? It is so nice that finally seems like we're getting a little bit of spring weather in Calgary. It's just been the snow is finally melting. It's fantastic. So we're going to go over to bonds now. And it's just insane what's been happening, guys. The moves in the bond market are just nuts. So this is the 5-year yield. Now I have to make sure I'm saying this right, because when I look at bonds in my broker, I'm looking at the price, like I'm not looking at the yield. So it gets really confusing because they work in the opposite way. So bond prices go down, yields go up. So basically, there's a sell off happening in the bond market right now, and the sell off has got pretty extreme. Like, we've had some serious moves over the past 5, 6 days. I mean, we've literally gone from down here at this 1.4% range, which was a substantial pullback, and we have just catapulted up. And what I actually put this thought out a while ago, which was that essentially it was going to pull back and then go higher after the rate hike, and it pulled back. It did go higher, just not in the time frame that I was thinking of. But the funny thing is, I want to see if I can clear this arrow off. There we go. It's a little bit clearer now. There's even like a gap. So like when you get gaps happen like this, it's extremely bullish. And even though it's bearish because the bonds are actually going down in price, but the yield right now is absolutely flying. So you're probably wondering, well, Luke, why on earth are you telling me this? Why are you telling me that the yield's going up? Well, the thing is, when yields fly like this, and they're flying also on the treasury, it basically means that, guess what? That means that corporate debt yields, junk debt yields are also going to fly up higher. And that's exactly what's happened. We've had some big moves today in the corporate debt market. And the interesting thing is, guys, basically, another interesting fact is when bonds are usually going down like this, you would normally be seeing the currency actually become more stable or even stronger, but the opposite is happening. So what that suggests is something very different is going on in the bond market. Now, it's very hard to tell with the US treasuries because the US is kind of a safe haven currency. So you can't really tell so much. But Canada, like, I've been looking over the past couple of weeks trying to figure out something that correlates with the Canadian dollar. And it was very interesting when I saw the Canadian dollar was falling as these yields were rising. Because what that suggests, guys, is that foreign buyers, because you may not know this, but about 20% of all the government's debt is owned by foreign countries. So if foreign countries like China, they don't like what Canada is doing or agree with what Canada is doing with Russia and Ukraine and the whole situation, and we're not going to get into that. But there's a great documentary that I want you to watch, which is called Ukraine on Fire. It's on YouTube. It's actually been took down, I think, 2 or 3 times now. They've tried to take it down, but they've actually realized that, hey, this is actually real. But anyway, it's basically a very interesting documentary. Everybody needs to watch it just to understand a little history on Ukraine's past, before you kind of make up your decision of where you stand, or if you're just an observer like I am of the whole situation over there. But the thing is, guys, the 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 fact that the currency is going down and the yields are going up, that means people are selling bonds and they're moving their money out of the currency and they're moving it somewhere else. So that's probably foreign central banks or foreign companies that bought Canadian bonds that are selling them, and they are moving out of the Canadian dollar altogether. That is never a good sign to have. And that forces, again, more pressure on the central bank now to hike rates. They've just got, I mean, talk about being attacked from all angles. I mean, people buying houses right now, getting into lots of debt, have no clue the risks that they are taking. If it backfires, which is looking like it's going to, because the writing is on the wall in terms of where the yields have gone over the past eight 9 months, then they are in serious trouble, especially the people who are on variable rates and just completely vulnerable at the whim of interest rate rises. At least for the people who took out fixed rates, they knew that they could afford it at that point in time. I mean, even though the fixed rate mortgage and with the stress tests and everything like that, you can still afford way more than you can actually afford. And I think I shared it on Twitter, but somebody emailed me last week and they basically said that, well, they sent me a ton of info. Oh, no, I didn't put this out. I'm not sure if I should really say this. But they emailed me a load of stuff. And anyway, I'm not going to get into the details of all this stuff. They shouldn't have. Please do not email me like people's personal info, even if you think it's relevant, people's personal information and stuff like that. But anyway, the crux of it was this guy works for a bank and he'd emailed me some stuff and he was saying that look at how much people are writing down what they pay for things like groceries. So this family of four apparently who were trying to qualify for a home loan will put in that they spent $200 a month on groceries, only 100 on natural gas. Like, the thing is, this is the thing. The bank is going to ask you, what do you spend on all these different things? And then people are just flat out lying about that. So when they calculate their balance sheet, their household balance sheet, they're thinking, wow, they've got a lot of free cash flow. And they don't really care, guys. The people on the other side of the desk, they're trying to sell you a mortgage on commission. You think they care if you're telling lies? In fact, they love it. If you're telling lies and they don't know about it, that's a win-win for them because they're going to approve that mortgage, everything's legit, and really it's the person who lied, committing fraud in the first place, that made the mistake. But the banks also just look the other way when they should be scrutinizing people's applications. And this is the absolute insane thing. So with this yield going so high, so we're going to switch the chart now to a monthly, just to give you some perspective on how this has moved. You are now talking about 2018 levels we're heading to. And if we breach this level here, guys, we're heading back to, guess what? I think it's something like, let me zoom out, make sure I'm not, I think it's 2011. Yeah, 2011, guys. We're heading back to 2011 levels. So if we get up here, bound to pull back once we start getting up to these levels, if we get there. And then the next stop, you're talking about 2011 levels. That would send fixed rate mortgages to around 4.5%, 5%. Like, that is just insane. But we've been seeing the same sort of moves in the bond markets across the globe, all the Western bond markets. Same things happening in the US, in England, in New Zealand, Australia. So this is not good. And you have to remember that the East, the big countries like India, China, Russia, these big other economies and powers, they don't like the West as much as they used to. And they especially don't like their monetary policy. And they're especially starting to question the dollar, the US dollar, that is. And I never thought we'd see the US dollar something happen over the next 5 years. I thought it would be way off, but it could be sooner than that because the thing is, China is going to be looking at what's happening in Russia right now, and it owns tons of US government debt. And is it thinking, well, maybe I should start selling these because if I do something they don't like and then they put sanctions on me, is it really the thing I want to be in? So it's incredibly interesting that this is happening. But this is insane, guys. We're at 0.5% for interest rates. Just think about that. 0.5%. So 0.5% is nothing. The bond yields are going north of 2% now. This is just insane. And it broke out of this range that was happening down here. And we're going to see over this week, I guess, whether it's a breakout or a fake out. And the difference between a breakout and a fake out is sometimes they push markets upwards in order to raid people's stops. That's how the banks basically generate liquidity so they can get their massive orders in. A lot of people don't know this. This is basically the fundamental strategy that I trade off, is trading with the banks instead of trading with most people. And it works very well because the banks are pretty predictable in what they're going to do, whereas the retail trader, not so much. But the thing is, the US as well, this is the US 10 years, sorry, and that's absolutely exploding higher as well. And then the consequential thing that happens with this that not a lot of people know is MBS. So MBS is mortgage-backed securities, and basically they work the same as corporate debt. So when treasuries go up, mortgage-backed securities go down. So if the government of Canada bonds are going up, then that means mortgage-backed security prices are going down. And that's what puts the upward pressure on rates, because these securities now, they yield more. So they have to make up for that by raising rates. And you can even see on this chart, unfortunately, we don't have data like this in Canada, but you can see MBS prices are significantly weaker so far today. This strong downward movement in MBS will most likely result in higher mortgage rates today. And then you can see treasuries, these are yields that are up. And the reason they're red is because the bonds are actually selling off. So yeah, you've got all of these that are down. But if you look at this chart, which looks really pixelated for some reason, but it is way down here now. Like, it is absolutely selling off. It's well under all the moving averages. This is not a good sign at all, because it essentially puts the central bank in the most awkward position it could possibly be in, where it's got things like interest rates going just sky high, and to battle that, it's got to raise interest rates, which is just a dilemma that the central bank has backed itself into a corner, but they always do. So yeah, if you look at that, you can see. And then another thing that I want to go through is obviously the Canadian dollar, what happened there. And it was a big move down today. Let me share my screen on that. So it was a big move down today, and it happened as the yields were going up. So that suggests to me that if that's happening, then there's money going out of the Canadian dollar. People are selling their Government of Canada bonds, and they're getting their money out of the Canadian currency. So it's very interesting. And Canada was very weak currency today because I was actually buying the pound versus the Canadian dollar. It was up quite a bit. But yeah, like, if you look at, and now we're going to just look at some of these tech stocks that have just got obliterated, and we have to have a moment's silence for all those people that are buying the dip right now. So we'll just have 5 seconds silence for them. Poor souls. But those people are literally, look at this. You want to know how fast a market can turn on you? Take a look at Shopify, because literally, look how long it took to get from down here to up here. This is February 2020, guys. February 2020. Okay, and it took essentially to November 2021. So like 16, 18 months. And to get from November down to here in the span of like 5 or 6 months. So like literally 1/3 of the time it's took to get upwards, it's took to fall. So it has fell drastically. And a lot of people are going to be buying the dip on this, guys. A lot of people are going to be buying the dip thinking, there's no way that could go wrong. Look how undervalued this is. But people forget, a lot of people didn't even invest in stocks before 2020. And that's where I really feel the mistake has been made, because a lot of people value things on what it was worth before 2020, forgetting, in fact, that tech stocks were in a bubble before 2020. So the thing is, it's just really alarming that I see people who are buying this stuff all the time, and could go up, could go down, but the chances are it's going to go down even more, especially with all the rate hikes that are coming. It's going to be interesting to see what happens, guys, and we're going to go live whenever the interest rate decisions are. We might not go live on, I think it's Wednesday or Thursday when the decision is made. Depends what sort of reaction we get in markets, whether it's worth it, because I also want to rope in the Bank of England's rate decision that's also coming, I think, afterwards on Thursday or Friday. And then we've also got the CPI print that is coming sometime this week for Canada. So it's an incredibly interesting week for data that we need to be keeping an eye on. Now, the other thing is oil. Obviously, everybody's talking about oil, and oil has just gone, it went parabolic, and now it's coming back to the downside. So the thing is, there's two levels of support that I've worked out there, but basically, obviously, a move like this, it's like I always say, when you have moves like this, they're just totally unsustainable, really. They happen way too quickly. If you look at how it rose up here, that's a nice range to rise, good solid uptrend. This is going parabolic, and then it comes back down. But the thing is, it's still in this uptrend. So it could correct to the trend, which would be here, between here and here, potentially, and then it could continue upwards. So it's one thing I'm definitely going to monitor for a trade on oil, because I'm thinking that, I'm bullish on oil. But the thing is, we'll have to see what happens. I know there's a lot of uncertainty about what OPEC is going to do with output at the moment. So it's going to be very interesting to see. But with all the supply shortages that are happening with oil inventories, I don't see it's staying down for long unless there's huge gains. But again, like, the amount of money that these sort of moves wipe out is absolutely insane, guys. Just insane. So that is something to definitely bear in mind, because the amount of money that that is just being wiped out is just kind of crazy, especially in tech stocks, like Shopify. So it's what's this then? You're awfully quiet tonight, guys, on the chat. Nobody's really saying anything. My buddy said he just sent 20K to his broker to buy the dip. By the way, his broker has only been in the investment business 5 years. Yeah, that's insane. You've really got to trust your broker. I don't even trust one broker. I've got three brokers, and they're all in different countries. One's in the Bahamas, one's in the UK, the other's in Canada. I got the least money in Canada, obviously, but the interesting thing is, you've got to be diversified. I think now is a time that you really have to be diversified in your banking, diversified in everything, currencies, you name it. You just need to diversify. Don't have all your eggs in one basket. It's never a good idea. um, it's absolutely insane. I expect bond yields to double within 1.5 year, maybe in a year or two. Yeah, it could be. The way it's going, the upward pressure on bond yields is absolutely insane. I mean, if we go if we go back here and then we go CA05Y, um, and then we look, it's just insane. The levels that it's at. I mean, this chart doesn't go back, but for some reason, anyways, you're looking at 2018. That is just absolutely insane. So you really got to, and David, I wonder if do they have HELOC in New Zealand as well? Is that a thing? And is that part of the housing market boom there? If you had $1 million to invest, where would you put your money? That's a good question. I'd have to really sit down and think about that. That's not a decision I would make in 5 minutes. That's for certain. But yeah, there's I would definitely keep a substantial portion as dry powder at the moment because I believe that there's going to be opportunity for that. I would definitely look at investing in real estate in countries that aren't Canada, particularly Southern America and Central America. These are countries that are going to thrive, economies that are going to thrive over the next 2 decades, I believe. So that's what I'd be looking to do. And yeah, but I need some time to think about that. I need your opinion. Have a huge variable mortgage, 150K HELOC. Am I going? Did you want it sweet or true? Yeah. It's because you are here, I'll guess true. So no, you're in deep cat. So David, let us know if New Zealand is having the home equity line of credits. Like, are they a thing there? Because I'm incredibly interested to see what you think about that. I'm guessing that they probably are because they're a big contributing factor to the housing market here and house hoarding. House hoarding is great, by the way, great when prices are going up, not so good when prices are going down. The complete opposite. And that's the thing, guys. You know, it took me years and years to master psychology and markets. And don't get me wrong, people can do it really quickly, quicker than I can. I don't claim to be the smartest person in the room. I'm really not. Um, but mastering psychology and markets is very difficult because you have to change the way you think on everything and learn to think in probabilities. Do you think the average Joe or Jane knows that? They don't have a clue. So yeah, they're saying I'm going to hold because it's easy to hold when prices are going up. But and they'll probably say, even if prices go down, I'm going to hold. But yeah, try that psychologically when prices go down 30% and you're holding the bag on some asset and then the renter stops paying the rent and things just start going against you. Try and hold off selling then. The thing is, it's too easy to say, yeah, I'll just hold it like right now. But the thing is, it's so much more complicated than that. And people just don't understand the risk of that. They don't accept the risk wholeheartedly. And this is why a lot of people ask for investment advice, and I don't give investment advice. And I would never do it for these reasons. Is the thing is, nobody wants accountability right now. In fact, nobody's wanted accountability for as long as I can remember. So it's the same in politics, but it's the same in real life, unfortunately. So people want somebody to blame when things go wrong. It's like if I say, oh, I'm long this stock, and then you go buy this stock, and then it starts going down in price and it goes down 70%. And you then go, why did you tell me to buy that stock? And I said, well, I was sucked out of it. Did you not put any risk management in there or anything like that? But the thing is, that's the thing. The devil is in the details, and people are just so reliant on other people, and they use it to blame other people. Like I guarantee you, when prices go down and when people are in trouble, they'll be blaming each other, but they won't ever take on the responsibility themselves. And that was something hard that I had to really deal with as a trader when I was losing money, like every trader does to start off with. And it was hard to accept accountability. And even I used to throw blame around at different people that were mentoring me. And it was just really tough. And I was lucky to be in a position where I had somebody mentoring me that is extremely successful in trading, and they did it for nothing. Otherwise, I don't think I'd still be in this game. So the thing is, it's just, and it's a slow growth thing as well. Like trading is not something you're just $1 million instantly. It takes time. You've got to build it slowly. And that's what the opposite of what people do these days. They just YOLO all their money into the NASDAQ and tech stocks. So it's just absolutely insane. So David's in here now. So David's saying HELOC in NZ. We don't call it HELOC, but the same facility is available. Surprise, surprise. And the housing market's booming. Look at that. You can access additional credit on revolving mortgages. So different name, same deal. Fair enough. I'm going to look into that. The real problem is Biden. He thinks that money printing creates growth, but in reality, it's fake growth. Yeah, I mean, he's a total clown when it comes to it but the thing is, Trump was a good president on some different things. Like, he always used to speak his mind. He wasn't a traditional politician. But I don't have good memories of what Trump was doing when the spacer sickness hit, because he was the one going, turn on the printing press. He was the one egging on the Federal Reserve, lower the rates, lower the rates. He was the one egging all of that on. And he was the one who really started that fire. So it doesn't matter what president you got. I mean, Biden is a nut job, and he's one of the worst presidents of all time, in my opinion. But it's the same. I'm not going to use profanity, but it's the same garbage, different president. It's exactly the same. Are they really in charge? No, that's the real thing that we got to say about that. But yeah, it's all fake growth. It is all fake growth. Do you want to know which foreign countries are actually doing good and are worth investing in the next few years? Are you asking me that question? Or I'm not sure what you mean by that. Or if you're going to tell us, I have no idea. Looks like you're asking, looks like you're going to tell us. And banks seem to reward stupid over, say, investment, actively advertising to morons that they can draw down on increased equity for life's little emergencies like a holiday or buying a boat. And there's an interesting thing about that. So the repo lots and the auction houses here in Calgary, starting to see lots of RVs, starting to see lots of boats. So it's incredibly interesting that is starting to surge, and cars as well. There's a lot of cars that are at the auction right now, which is really interesting. Biden is like Enzi's Cindy, neither understand basic economics. Biden is the worst president of all time. His single achievement is making people want Trump back. Yeah, that is so true. Well done, David. Well said. But yeah, that is pretty much where Biden's at. I'll agree with that too. I mean, none of these people have any clue about economics, and that's really not even fundamentally. And even people like Tiff McClem, the way they're schooled in economics, you should look at it. They all go to the same universities and get taught in the same different way. And the way they're taught about bubbles is they occur, there's nothing they can do about it, and everything like that, which is not the case. They create the bubbles. And if they actually understood what they were doing, then they wouldn't be creating them. But the fact is, they just don't understand. Now, when they were saying inflation was transitory, it's tough to know whether they were actually believing that or hoping that. But the thing is, their credibility is at stake here. And with everything that's going on with currency wars and different pressures that are happening on the central bank, can you imagine if the Fed came out and hiked 50 basis points this week? Like, I could see it happening. I think it's a lower percentage. I think they'll just go with the 25 basis points. But who knows? Like, could they surprise the markets? That would be an interesting thing. But yeah, it's going to be incredibly interesting going forward. And oh, I read it wrong. Pardon me. So, do you know which foreign countries are actually doing good? Oh, right. I see what you mean. Yeah, I mean, I've been looking at Costa Rica, Panama, Mexico, Colombia is a good place. If you don't follow George Gammon, check him out. He's big in Colombia. There's a lot of good places in Colombia. I've also heard, and I haven't done research so much on the South American countries, but Brazil, I've also heard is pretty good, and Ecuador, but I don't really know so much about them. I've been kind of focusing on Mexico, Costa Rica, Panama, because that's where you can't spread it too far, I suppose, your search. But Costa Rica is extremely good, I think, and Panama too is very interesting place to look at property, and Mexico's really good as well, to be honest, because the yields you get on vacation properties there are very good. And I think when times are bad and we go into this recession, then there's going to be a lot of deals available in places like Mexico, because the thing is, um, a lot of people jump the gun. From what I've heard from realtors, a lot of people have been buying property for the past couple of years since the pandemic hit down in Mexico, and obviously Costa Rica and Panama probably as well. And the thing is, they've ramped up building now massively. So they're building everywhere in places like Quinta Roo, and that there's a lot of new supply coming to the market, and the demand is going down right now. And the thing is, if you then head into a recession and people need to liquidate assets, they generally go for the things they don't need the most first. That'll be your RVs, your boats, your second homes, things like that. So that's why it's always interesting to keep an eye on what's going on Kijiji, what's going on at your local auction house, because that really gives you an idea of how people are faring. Because it's not going to be foreclosures that you're going to see first. It's going to be people hard done to selling stuff, selling jewelry, selling boats, selling whatever RVs, and those are the things that people have gorged on during the cerveza sickness. So they are incredibly. They're places. Put it this way, that I've got on my watch list right now, and we're going down to Quintaru in June, which is the low season, to check out different developments and what's going on there. I'm going to be videoing it for the channel, so you'll be able to see what you get in Mexico for your money. It will blow most people's minds here in Canada, because Canada is just so acutely overvalued. But yeah, it is a joke, and thanks for saying that I read it wrong. I swear I'm dyslexic, and I just, because I switch words all the time, and I think that's what dyslexic people do. Actually, modern academic economics tells its accolades that bubbles do not occur, or at least cannot be identified. Yeah, that's true. The only people who don't see a collapse coming are formerly Kevin Fats and finance economics professors. Yeah, that's very true as well. They ain't going to see this one coming. And it's like I've said to people, the central bankers, yeah, a lot of people are betting that the central bankers aren't going to raise rates because the real estate market will tank. Well, the thing is, they will, because it won't tank instantaneously, and it will be too late by the time they realize. And who knows what decline it's going to take to get to a crash, because once it declines so much, that's when you get that trigger event, which happens in the financial system with all the stress because of the contraction of the credit, which we're going to see sooner or later, guys. Sooner or later, we're going to see it. And the thing is, it's got so large now that it's just unavoidable, in my opinion. Unavoidable. RVs are a bit mixed. There'll be new homes for many people, but cars, jet skis, basically toys, you'll pick up for 10 cents on the dollar. Yeah, you know what? Even I was thinking about maybe buying a repo RV and just moving out of this massive house that we're in and we don't need. Um, because everything's so expensive. And to be honest, we've been looking for a smaller place for a while, but it's just been absolutely insane to find anywhere decent. has just been really tough. But yeah, I've been thinking about, just getting one of those gigantic RVs and working from that. And that way we could just, drive wherever we wanted and take the office and the house with us. I know there are a lot of people that do it on YouTube, so I know it's possible. And those RVs are pretty damn nice if you've gone in some of them. So yeah, it's really incredible. But anyway, guys, I'm going to leave it there. Thank you so much for watching and being on the live stream. Hit that like button so other people see it. Check out the video in the description when I was on the Canadian Real Estate Podcast show. You can see it. It's also on Spotify. I put both links there. And I will see you in the next live stream. Keep an eye on markets. Big week ahead. Feds possibly raising, shouldn't say that with certainty. Bank of England, CPI for Canada. Incredibly interesting week ahead, guys. So thank you so much for watching. See you in the next one. Peace, guys.